since going public. Reynolds CEO Lance Mitchell joins us now in a first on CNBC interview. Lance, thanks for being here. Congratulations on the IPO.
Thank you, and we appreciate the invitation to talk with you today about our IPO and Reynolds Consumer Products.
So in terms of the capital you've raised today, you're going to take it to pay down debt, and also it looks like you intend to pay a quarterly cash dividend as well, right? That's the plan?
Yes, we're going to pay 50% of net income, which is a yield of about 3.4% on an ongoing basis.
Got it. Given the fact that we have seen these coronavirus concerns, it's really been whacking commodity prices as of late, including aluminum. What does that mean for Reynolds overall? And I guess, what is your outlook for some of those raw commodities that you use to make your products?
Well, those commodities for us is coming down will provide us with a tailwind as we're able to hold on to those prices in the marketplace, and actually provides a positive forward outlook for our company.
Lance, I wonder how some trends, especially towards sustainability, affect your strategy and outlook going forward. People hate throwing plastic away, or aluminum, especially these days. What do you do to adapt to the consumer tastes and the trends when you've got some really strong brands in those legacy businesses?
Yeah, so Reynolds Consumer Products has a sustainability focus for a number of years. This is not a new thing on our dashboard. We have developed a broad range of portfolio of sustainable product choices for consumers. For example, aluminum foil made from 100% recycled aluminum, waste bags that are made from post-consumer recycled plastics, fully compostable paper cups and paper plates. Sandwich bags that are made from compostable wax paper, and the list continues. So we're well positioned as consumers' changes occur in habits and practices to be able to participate in those changes.
How do some of those newer products sell versus your more traditional aluminum foil, for example?
They're growing moderately faster, and we're seeing that particularly in some geographies of the United States. So as those changes across different geographies occur from consumer sentiment, we're well positioned to be able to continue to grow.
We're entering a period here where investors are interested in dividends and yield. You say your policy on dividends will happen upon closing, but can you be more specific?
Yeah, our long-term plan is to continue with that 50% of net income. And as we buy down debt, we're going to be able to improve that net income and continue to grow our overall earnings. We've demonstrated our earnings growth of EBITDA for the last 5 years has been 5.2%, and our top line growth over 3%. With our product introductions that we have in the pipeline and our history of new product development, 21% of our revenue in 2018 came from products that were less than 3 years old, and we're well positioned to be continuing with that kind of innovation pipeline going forward.
We've been watching commodity input costs, CRB and all of that this year. Is your outlook that that's going to rise markedly anytime in the next 12 months?
No, we see it stable to slightly declining in the key commodities we purchase, which are aluminum and resin. So that was a headwind for a couple of years previously, but is now providing us a tailwind as we go forward.
Where are the biggest growth opportunities? Are they here in the U.S. or is it overseas?
We are a U.S. and Canadian company. We have 16 plants in the U.S. and 1 plant in Canada. Our focus and our winning formula for growth has been U.S. and Canada, and our focus is to continue with that winning formula.
Lance, as Amazon continues to grow, and we saw from their earnings last night that they do, and other players as well, it seems the threat from generics also grows. Do you see it that way, and do you have to market differently in the e-commerce and digital era to protect your brand and protect what moat you have?
Yeah, we're well positioned to grow in e-commerce. We had our own team established over 5 years ago to be able to really be prepared for growth in that channel. And we're well positioned with our products because they're shelf stable and they're cost effective to ship directly to consumers. So it has not been radical growth of these categories into e-commerce. It's still primarily traditional channels. But if those consumer habits change, we'll be well positioned for growth.
But protecting against the store brands potentially from the likes of Amazon?
Yeah, well, across all channels. When you look at the channels that we participate in and the products that we participate in, the categories of brand and store brands in all of these categories in the last 5 years has been very stable.
All right, Lance Mitchell.